we need to understand and we need to look at the setting. The setting, both macro, market valuations, and the trajectory of the earnings, and also domestic institutional investors and what their positioning is. While it's very easy to say that, look, if rates, global rates, they go higher, liquidity will move out, and that's going to be end of the liquidity curve for emerging markets. So let's look at it. First, the scenario. The scenario for on the macro front for India is vastly different than what it was in 2015, both in terms of macro, our forex reserve, the curve of the interest rate, and also our ability to really digest a currency shock, because our forex reserves are now north of $500 billion. Second, earnings trajectory. Between post 2015, we saw a real crunch down in earnings, and especially for large sectors. Power, banks had to be recapitalized, they had to go through a painful NPA cycle, and there was no large private sector capex, which in a sense was coming out because the economy was in a contraction mode. Third, which I think is the most important point, is the starting point of valuations. When the last rate cycle started, the Nifty valuations were vastly different from what they are. The Nifty valuations were in early teens. Now they are in late teens. Actually, they are above 20% if you look at some estimates. So that is a big difference. While the economy is on a much stronger wicket, the earnings trajectory for next couple of years would be very different from what it was in 2015, where you're contracting versus now you're expanding. The challenge is that your starting point of valuations also is strikingly different. So this in a sense becomes the limiting factor. So for the risk for the market, I guess, is not so much so on the earnings front, it is on the valuation front. At what point in time Indian markets, they start becoming attractive again. And if I may just throw one more ingredient in the melting pot, I think the change is domestic institutional investors. The hurrah with which domestic institutional investors have come back, this is retail money when I say domestic institutional investors, it talks about a serious commitment coming to equity as an asset class by the new millennials, by what essentially is happening in terms of the household savings coming back. So that's also a differentiating factor. Again, you can toss it up and you can put a cherry on the top by using words like startup, how the economy has become much more efficient, how productivity rates have gone higher, and how tech in a sense has become a much more larger contributor to India's GDP and the total earnings picture. So the difference is that banks are at a different cusp of cycle, IT is at a different cusp of cycle. If you take the valuation aspect aside, which is going to be a limiting factor, I think this rate hike cycle is strikingly different.